Hello, this is Books of the Stock Market. How's everyone doing? As for me, I discovered why my audio quality in my previous videos were so mediocre, even with a new mic. Like, there are times when my audio quality, even after buying a new mic, was worse than the audio quality before buying the mic. So I discovered that I was having audio problems because I was pointing the mic in the wrong direction. So I had to place the mic so that the body of the mic was pointing at me, but until now it's pointing the mic such that the top of the mic was near my mouth. Anyways, with that small rant out of the way, let's move on to today's topic. Last video, we went over how to create trend lines and adjust them. This video, we will continue the topic on trend lines. This video will introduce different trend lines and concepts that will help you navigate your trades. We will also be going over multiple examples that will help you see the application of these different trend lines and concepts. The first topic we'll be going over are channel lines. Channel lines are also called return lines, and the channel line and the trend line will be used as a set of two parallel lines that indicate the boundaries of the price range. Basically, price will be trading within these two lines, so the person will be able to predict price action. Like trend lines, the strength of the channel lines depends on two factors: how long the channel line was held and how many times it was tested. So when do we use channel lines? Channel lines are used for short-term profit taking or adding to your position. Channel lines also can show signs of a weakening trend when the channel line breaks. Now that we know what channel lines are, how do we draw them? Fortunately, it's pretty simple. First, you draw the up or down trend line. If you have any questions about drawing the up or down trend line, watch Trendlines Part 1. I'll link the video in the comment section below. From there, you will need to clone the trend line, which is pretty straightforward. You would just copy and paste the trend line. I use TradingView, and all you have to do is Ctrl-C and V. And I'm pretty sure other websites have this functionality. The final step is to try and fit the clone trend line, such that the wicks touch it. Remember, any type of trend line must be drawn such that all price action is taken into account for. So for candlesticks, you will draw the channel line such that the wicks touch it, and for bar charts, you will want your highs and lows to touch it. Let's now look at an example. So this is QQQ, which is an ETF that mirrors the Nasdaq. And the first element I drew was the downtrend line as the stock was heading downwards. I then copy and pasted the line and tried to fit it such that the wicks hit the lines. Now that we got our channel line set up, we can see the general price range of this downtrend. This, in return, would help us make trades. Furthermore, as shown in the purple box, once this channel line was broken, the trend reversed. As we saw in the previous example, the channel broke. What do we do from here? Well, we just need to redo the same steps. So we will first draw the up or down trend line, then we will clone the trend line, and then finally try to fit the clone trend line so that the wicks touch it. Here, we see the same chart as shown before. Since the channel was broken at the purple rectangle, we saw a reverse in the trend. This means we need a new trend line. Since the stock is not going in an uptrend, we would first draw the up trend line. Then, we'll copy this line and paste it such that the wicks touch the line. As seen in the triangle, we see a break in the channel line, and this means that the trend has reversed. This means we will need to repeat this process again once a downtrend line can be drawn. The next topic we'll talk about are percent retracements and how some type of trend lines may allow traders to predict price action once the trend line breaks. The first commonly seen retracement is the 50% retracement. This is when price retracts 50% of its movement once the trend reverses. For instance, if price moved from $500 to $1,000 and the trend line breaks, we will see price retract to $750. Other than the 50% retracement pattern, we can measure retracements into thirds. For instance, many technical analysts state that a 33% retracement is the minimum, while a 66% retracement is usually the maximum. You can see these numbers come up in Fibonacci ratios and the Elliott wave theory, and both of these concepts will be explained in later videos, so remember to subscribe to the channel if you don't want to miss out. For now, we'll use the 33% and the 66% numbers for the concept of speed resistance lines. So what are speed resistant lines? Speed resistance lines are a combination of trend lines that measure percent retracements. Basically, they measure the rate of increase or decrease of a stock's price. Now that we know what they are, let's move on to the topic of how to draw them. In an uptrend, you would first draw a vertical line from the highest point of the stock to the bottom of the chart. Then you would divide this vertical line into thirds. You then draw a line starting from when the trend reversed to the divided vertical line. In a downtrend, you start off by drawing a vertical line from the lowest point of the downtrend to the level when the downtrend started. You would then divide this into thirds. Finally, you would draw the trend lines from when the trend reversed to the divided vertical line. If this sounds a bit complicated, don't worry, I have an example coming up. Here we see SPY, which is an ETF that mirrors the S&P 500. We see that the price was suddenly reversed and it is going on a downtrend. Since it is a downtrend, we will draw a vertical line from the lowest point of the downtrend to the level when the downtrend started, as shown in the red line. This red line was produced by using the ruler tool as shown in the black box on the left side of this image. Here, we see the distance between the 2 points come up to be around $27.08. From here, we will divide $27.08 into 3 and indicate them so we can draw our trend lines. So $27.08 divided by 3 is around $9. So the top was $354.06, and if we subtract 9 from that, it will be around $345, which is the level of the second purple line. If we subtract another $9, it will be around $336, which is indicated by the third purple line from the top. Finally, we can draw the line from the top of the trend to our segmented sections. If we clean this out a little bit, this is what we get. So what do you see? We see that SPY has broken through our 66% line and seems to be really struggling. This doesn't seem really bullish, as if it was just a correction, then it would have eventually bounced off this 66% line. Since it broke through it, we could see more downward action in the future. The only problem with speed resistance lines is that you have to redraw them pretty often. The main reason for this is because you need to redraw them every time the stock makes a new high in an uptrend or a new low in a downtrend. Also, it is important to remember that like all lines, these lines switch rows when broken. So the downtrend lines I drew in the previous slide would act as resistance as price broke and fell under it. The final topic of this video will be about price gaps. But before we go into price gaps, we must understand what reversal days are. There are two types of reversal days. The first one is called the top reversal day. This is when price goes to all-time highs but closes lower than the day before it. This may foreshadow a reversal in the trend. The other type is called the bottom reversal day, and this is when price goes to all-time lows but closes higher than the day before it. This can also foreshadow a reversal in the trend. On these 2 days, there is more volume, and this concept also applies to weeks and months. For instance, a top weekly reversal would occur when the market makes new lows that week, but on Friday, it closes higher than the previous Friday's close. This can also apply to months, as in terms of significance, the longer the time frame, the more significant it is. So a weekly reversal would be more significant than a daily reversal. Now, let's talk about price gaps. Price gaps are defined as areas on a bar chart or candlestick chart where there is no trading. For instance, in the black box, we see a gap as the next day opened higher than the previous day's high. Also, there are two types of gaps. The first type of gap is called the upside gap, and this is when prices open above the highest price of the previous day. So the black box will be an example of an upside gap. The second type of gap is called the downside gap, and this is when prices open below the low of the previous day. Before moving away from definitions and diving into examples, it is important to note that gaps are not always filled. Within the types of gaps, there are 3 categories of gaps. The first category is called the breakaway gap, and this occurs after breaking resistance or support on heavy volume. This gap is not always filled. After a breakaway gap, a runaway gap will be produced, which is also known as the measuring gap. This occurs at around the middle of the overall move and occurs with moderate volume. This gap is not always filled. After the runaway gap, an exhaustion gap forms, and this occurs at the end of the trend. More often than not, this gap gets filled and the trend reverses. Let's look at an example. So here we see the stock of applied materials. As shown, we see a green uptrend line. However, it gets broken and a breakaway gap forms in the first purple box, starting from the left. From there, we see the runaway gap form in the second purple box, starting from the left. The stock continued to fall, and as we reach the third purple box, this is where the exhaustion gap forms. And we should expect a reversal in the trend, which does come a little bit later as it gaps up in the blue box. More importantly, however, it is important to understand that in the real world, the textbook definitions of technical analysis may not be always followed. For instance, in this case, we see the runaway gap not form in the middle of the overall price movement, but rather at the beginning. Furthermore, the runaway gap gets filled as shown here, but the price still continues to fall. Due to these inconsistencies, it is hard to do technical analysis and makes this really subjective, as some people may disagree with my technical analysis. Therefore, it is important to note that you must practice what you have learned from my videos. Well, that's it for this video. I hope everyone learned as much as I did reading the book, as that is the whole point of this channel. In this video, we learned about trendlines, which is fundamental to technical analysis. The next video will be an exciting one, as we will be looking at major reversal patterns. So if you don't want to miss out, please subscribe to this channel. If you enjoyed this video and felt like you learned something new, like this video as it really supports the channel. If you have any questions, leave a comment below and I'll try my best to answer all the questions. Well, this is Books of the Stock Market, and I'll see you guys next Wednesday at 3 p.m. Central Time. Thanks.